Okay, let's take a look at the accounting process. Below is the basic accounting model for the accounting process. It captures the transactions that are processed ultimately into financial reports. Assets equals liabilities plus owner's equity. You'll hear that a lot throughout the semester as an accounting student and as an intro to accounting student. In other words, A equals L plus OE. Basically, assets, as you study what assets are, etc., a prime example of an asset would be a building of some kind. That building, whether even if you're an internet company, you're going to have a building somewhere. You're going to be housed out of somewhere. You'll also have, some type of machinery maybe moving your products out of the building, or building a product, a widget of some kind, maybe a vehicle of some kind. And these things comprise of your assets in the simplest form. Assets are provided by resources. The resources that provide for those assets will include the owner and the amount of money that the owner puts in, which could pay for the machines, the vehicles, maybe in terms of the liabilities, such as a banknote would provide for the purchase of a building. Because if you recall from basic algebra, if you subtracted this equation, the liabilities on both sides, then you have assets minus liabilities equals owner's equity. In other words, to find the worth here of the owner within this company, you simply take all the assets and you subtract the liabilities to come up with owner's equity. Let's look at some transactions using this basic accounting model. Here we have an example of where a college student named Jane on September 1st organized and created a company called Academic Lawn Services and invested $200 of her own money into the business. So here she put in capital of $200 on September 1st, and that capital then becomes cash on the asset side of this particular equation. Let's look at the next transaction. On September 15th, Academic Lawn Services borrowed $1,000 from the Bank of University. So here in the liabilities column, we have a banknote and notes payable of $1,000, which provided for $1,000 in cash. So if we had a cash T account running, and you'll learn this later, you've got 200 and 1,000 for cash. Let's look at the next example. On October 1st, the company purchased landscaping equipment for $1,000 in cash. Here on October 1st, $1,000 in cash was used. We'll credit that 1,000. And at the same time, we could actually create another asset T account called equipment and have $1,000 in there. Notice how there's a debit here for equipment and a credit here on cash. The asset column stays the same. It's a wash. Nothing needed to be done on the liabilities and owner's equity side of this basic accounting model. However, assets went down and went back up immediately. There's a second transaction that occurs on October 1st. The company purchased $10 in gas. Here, this is a decrease in cash and an increase in assets. It could be categorized under supplies, gas supplies. And we would handle it in the same way in terms of T accounts, in terms of cash. Instead of using an equipment T account, it could be a supplier or supplies T account. Let's look at the 15th. The company provided services for its first client and billed and collected $30. So here on the 15th, they received revenue and cash of $30 because right after they mowed a residential lawn, the person came out and gave them the money for it. So the equation again balances. It's important to note that the equation assets equals liabilities plus owner's equity can be expanded to assets equals liabilities plus owner's equity plus revenues minus expenses. Why is that? Because owner's equity is paid in capital the money that an owner decides to put into the company to invest into it. It is also the amount of money that the owner decides to leave in the company at an end of within the an end of a business cycle. Of course, minus withdrawals. So therefore, to think of it really easily, we can just simply expand our basic accounting model here and add plus revenues minus expenses. Alright, so on October the 17th, the company provided services for a large client and billed $100. They did not collect the cash. So even though they didn't collect the cash because of accrual accounting, which you'll learn more about throughout the semester, says that we need to recognize it as it's earned. So therefore, revenues is accounted for, and rather than cash being on the asset side being accounted for on the 17th, an accounts receivable will be recognized, meaning that we're going to receive this money at a later point in time, which will turn into cash. Once it turns into cash, we can then get rid of the accounts receivable. On October 30th, Jane paid her employees $50 for the work. So here on the owner's equity side, we see an expense of salaries of $50. And here on October 30th on the asset column, we can just simply decrease cash by $50. And also on October 30th, Jane expensed $5 in gas. So on the owner's equity column, we can say $5 in expenses here. What do we say here in the assets column? Is it a $5 in cash? Or is it $5 in gas supplies? It's $5 in gas supplies because on October 1st, she already had a cash outlay for gas supplies here. So the cash has already been taken out for it. And therefore we have $10 in supplies, of which according to accrual accounting, $5 of it has been now depleted and thus also expensed from the books. So now if you look at our asset column, we've got $1,275 added up on the left hand side, liabilities $1,000, owner's equity $275, liabilities plus owner's equity would be $1,275 and $1,275 on the asset side. The basic accounting model here thus balances.